In early June 2026, the world watched one number. Not a stock, not a currency, a single barrel of oil. It is the price quietly hidden inside almost everything you buy. On June 3rd, Brent crude touched about $101 a barrel. A war in the Middle East had set markets on fire. Newsrooms warned of a fresh global energy crisis. Drivers braced. Businesses recalculated. Everyone waited. Then, just weeks later, the price collapsed. By June 22nd, Brent had slipped to about $79. By June 26th, it had fallen further to about $72. Roughly a 22% drop in a single month. Up like a rocket, then down like a stone. How does the world's most important price swing this wildly? What lit the fuse and what put it out? And what did all of it mean for your wallet? This is the story behind the money. A 22% move can sound abstract, so picture it plainly. From $101 to $72, nearly $29 left every single barrel. The world burns roughly 100 million barrels a day. So that swing moves billions of dollars daily. It is like the planet's fuel bill rising, then falling overnight. Imagine your weekly shop jumping a quarter, then settling back. Now scale that across every factory, farm, and fleet. That is the size of what 1 month did to oil. First, the basics. Oil is price per barrel. 1 barrel holds about 159 liters of crude. Brent crude is the global benchmark for that price. Think of it as the headline price the whole world quotes. Most cargoes trade against it every single day. It is set by global supply and global demand. When buyers fear supply could vanish, they bid up fast. So the price is partly oil and partly emotion. Most oil is not bought the moment it is needed. It is bought in advance through contracts called futures. A buyer locks in a price for a delivery months ahead. This lets airlines and refiners plan their costs. But it also means the price reflects the future, not just today. If traders expect trouble ahead, they pay more now. That is why an oil price can move on a headline alone. Oil is not just fuel for cars. It moves the trucks, ships, and planes that carry everything. It powers factories and runs heavy machinery. It is turned into plastics, packaging, and fertilizer. It even goes into paint, medicines, and clothing fibers. The shirt, the phone, the lunch, €1, oil touch them all. So when oil rises, the cost of living rises with it. That is why one price can shake an entire economy. To understand the spike, look at one narrow waterway. The Strait of Hormuz in the Persian Gulf. It connects the Gulf's oil terminals to the open ocean. At its tightest, it is only about 33 kilometers wide. The usable shipping lanes inside are narrower still. Picture a single doorway for much of the world's oil. Tiny on a map, yet vital to the whole planet. Roughly a fifth of the world's oil passes through Hormuz. That is about 20% of global supply in one channel. Saudi, Iraqi, Kuwaiti, and Emirati exports flow through it. Tanker after tanker threads the same tight passage. If it closes, there is no easy detour for most of that oil. A few pipelines bypass it, but they cannot carry the same volume. The lost barrels could not simply reroute overnight. Threaten the strait, and the whole world feels it. In 2026, conflict broke out in the Middle East. It drew in both the United States and Iran. We tell this strictly as economics, not as politics. Our focus is the price, not the blame. For markets, the key fear was simple and immediate. Iran sits right along the Strait of Hormuz. Could the fighting shut that vital waterway? That one question began moving billions of dollars. Here is something key about how markets work. They do not wait for disaster to actually happen. They price the risk of it in advance. Traders feared losing a fifth of global oil overnight. Even a small chance of that is worth paying to avoid. So buyers scrambled to lock in barrels early. Each new headline added a little more fear premium. That premium pushed Brent up toward about $101. On June 3rd, 2026, Brent peaked near $101 a barrel. Oil had not flirted with $100 in a long time. That round number carries real psychological weight. It becomes a headline, and headlines shape behavior. Newsrooms warned of a deepening energy crisis. Drivers and businesses braced for the worst. At the peak, fear was firmly in control. Now, how does an oil spike actually reach your life? It travels through a chain, one link at a time. First, refineries turn crude into gasoline and diesel. Crude is the single biggest cost in that fuel. As crude climbs, those fuel costs climb too. Pump prices follow within days or weeks. Every fill-up quietly starts to cost more. Next, costlier diesel makes trucking and shipping pricier. Almost every product rides on a truck or a ship, so those higher transport costs spread everywhere. Oil also feeds the fertilizer that grows our crops. Pricier fertilizer means pricier farming, and that pushes up the cost of food. Step by step, one barrel touches the whole grocery basket. Let's make that chain real with one loaf of bread. Fertilizer made with oil and gas helped grow the wheat. Diesel ran the tractor that planted and harvested it. Fuel moved the grain to the mill, then to the bakery. More diesel carried the finished loaf to your store. Each link adds a few cents when oil jumps. Now repeat that for milk, coffee, and your online parcel. That is how a far-off strait reaches your kitchen table. Add up fuel, transport, and food, and you get inflation. A broad rise in the prices we all pay. This is why central banks watch oil so closely. A lasting spike can force interest rates higher. Higher rates touch mortgages, loans, and jobs. An oil shock can squeeze growth and prices at once. So an oil shock is really an everything shock. There is a hidden cost beyond the barrel itself. When a shipping route looks dangerous, insurance jumps. War risk premiums on tankers can soar overnight. Insuring a single voyage can suddenly cost far more. Some ships reroute, some simply wait out. Either way, oil reaches buyers slower and dearer. Those extra costs land in the final price too. Now here is the strange part of this story. With oil spiking, you would expect panic everywhere. You would expect stock markets to tumble. Instead, they stayed surprisingly calm. In fact, U.S. stocks pushed to record highs. Oil screamed danger while equities celebrated. Two opposite stories were unfolding at once. Why? A powerful AI-driven rally was underway. Investors poured money into technology and chips. They bet AI would reshape profits for years. That long-term optimism outweighed the oil war fear. Markets also bet the conflict would stay contained. And many big tech firms are light on oil costs. So AI hope and oil fear simply ran side by side. How can both moves be rational at the same time? Stocks and oil were pricing two different futures. Oil priced a sudden supply shock that might happen. Stocks priced years of growth that looked likely. Investors judged the war would not derail the economy. Energy is also a smaller share of output than decades ago. So a spike stings less than it once would have. Calm equities and frightened oil were not a contradiction. But one corner of markets flashed caution. Long-term government bond yields rose. A yield is the return investors demand to lend money. Yields often climb when investors fear inflation. Higher oil can mean higher prices down the road. It was a quiet signal under the loud rally. So the calm was real, but it was not complete. Then almost as fast the story turned. The fear that drove oil up began to fade. Word spread that the war might actually end. Diplomats were talking, and markets were listening. Each hopeful headline chipped away at the fear premium. Because markets reprice relief just as fast as fear, The turn did not arrive in a single moment. First came quiet back-channel contact between the sides. Then a pause in the fighting let tempers cool. Neutral mediators helped shape a working framework. Each step lowered the odds Hormuz would ever close. Traders watched every signal, recalculating in real time. With each milestone, a little more premium drained away. Step by step, war risk became a peace bet. The United States and Iran agreed to end the war. A peace deal was signed in Switzerland, a neutral setting for a high-stakes agreement. Crucially, they agreed to reopen the Strait of Hormuz. The single biggest fear was being removed. The barrels the world feared losing would keep flowing. And so oil's risk premium had a reason to deflate. Then came proof, not just promises. Persian Gulf exports recovered to about 75% of pre-war levels. Saudi Arabia resumed loading tankers at Ras Tanura. Ships moved freely through the strait once more. The oil the world feared losing was flowing again. Markets could finally see barrels, not just talk. Supply fear turned into supply relief. Recovery is best measured in barrels, not headlines. Gulf exports climbed back to roughly 75% of pre-war flows. Ras Tanura, a giant Saudi terminal, loaded tankers again. That single site handles an enormous share of exports. Its restart was a powerful signal of normality. Still, 75% means a quarter of flows were not yet back. Pipelines, schedules, and confidence all take time to reset. So relief was strong, but the recovery was not finished. The price fell hard, and it fell fast. By June 22nd, Brent was around $79. By June 26th, it sat near $72 a barrel. That is roughly a 22% drop in a single month. Nearly all of the war premium was gone. The fear that built it had simply evaporated. Why crash so quickly after rising so high? Because much of the spike was fear, not shortage. The physical oil was largely still flowing. Hormuz never actually closed during the scare. Think of the risk premium as an inflated balloon. Remove the fear, and the extra price escapes. Prices fall as fast as the story changes. For households, a falling oil price is welcome news. Cheaper crude can ease pump prices over time. Lower transport costs can slowly cool inflation. But the pump often falls slower than the market. Prices tend to rise like rockets, fall like feathers. Taxes and refining costs also blunt the relief. So the relief is real, just not instant. For the wider economy, lower oil eases pressure. It gives central banks a little more breathing room. Less inflation worry can mean steadier interest rates. Cheaper energy can support growth and spending. But oil exporters earn less when prices fall. Every price has winners and losers. Still, for most consumers, it is one less worry. But this calm is not guaranteed to last. Peace deals can be fragile and can break. If Hormuz were threatened again, fear returns fast. Exports are still recovering, not fully restored. At about 75% of pre-war levels, there is ground to make up. The same choke point could light the same fuse. Markets that repriced up can reprice up again. So what could actually send oil climbing again? A breakdown of the deal could revive the war premium. Any fresh threat near Hormuz would do it instantly. Producers could also choose to hold back supply. A faster-than-expected economy could lift demand. A weaker dollar can push the price higher too. And the last quarter of Gulf flows is still returning. Any of these could nudge the balloon back up. Hormuz is not the only force on oil. Producer decisions can add or hold back supply. Slowing economies can pull demand lower. New production elsewhere can soften any shortage. A strong dollar can also weigh on the price. Many hands push and pull this single price. So how worried should we actually be? Honestly, There are two fair ways to read this. On one side, the immediate shock has passed. Oil near $72 is far calmer than $101. Supply is flowing and inflation pressure is easing. On the other, the world's oil still leans on one strait. Relief today does not erase the underlying risk. Both things can be true at the same time. This single month taught a clear lesson. Oil moves on fear as much as on barrels. A single choke point can swing the global economy, and a single deal can swing it right back. The map sets the stakes, the mood sets the price. Understanding both is how you read the headlines. A quick and important note before we close. This is analysis and education, not investment advice. Prices and politics can change after this video. Always do your own research before any decision. The 2026 oil shock rose on fear and fell on relief. One narrow strait moved the entire world's prices. That is the story behind the money. This has been Chronicle. Thank you for watching.